Welcome back to the channel. I'm Crypto Trend Trader, and today we're going to be taking a look at some trading strategy rather than particular technical analysis on a specific coin. But before we get started, I'd like to remind you it's not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. All right, so basically, typically what's going to happen is in most assets, if they're not already trending in one direction, either in a distinct uptrend or distinct downtrend, you're going to basically end up in a range. You're going to end up consolidating for extended period of time, with a lot of indecision in the market, and people aren't sure exactly which direction you're going to go in. And as you can see, let's pull up just purely naked chart right here. As you can see, that's basically the situation that we have right here. We had a powerful move to the downside, and now we're just consolidating within this range. And you can basically look at it and say the range is somewhere around like 7,800 at the bottom right here. We've never had a close over the 4 hour above time frame below like the 7,800 range. And then if you go to the top of the range, you can say right around like 8,600. We haven't had a 4 hour candle close above that price, and we've had strong rejections in both directions from those. So now we're going to draw this white line here, and that's going to represent the bottom of this channel that we're discussing. And then you'll see we have this green or the red line here that's going to represent the top of this channel here. The red line we drew in, the green line is part of our Fibonacci tool. That's the 0.5 retracement for the move. Okay, so that's just like a different resistance that's in there, or support if we're above it. So now here we have this range basically that we've been bouncing around within here, and now we had drawn in this diagonal upsloping support line because that was acting as basically a bounce point from here, and then we had come down, found support, fell under it, found resistance, and then we're coming back up to it right now, and I suspect we'll find it as resistance, but we may get that powerful move back up here. And now again, what can we expect to happen? When we came back down to this range, we took our entry point, just like we had discussed in that video. We got filled on this wick right here at the 78.35 was our fill, and we got filled on this wick right here. We had this already in place, and then from that point in time, it had basically moved up here and then come back down, never as low again. But once you get that move up, what you want to do is you want to move your stop loss to break even. So if the price does come back down to a lower price, you get stopped out and you're in a better position. Alternatively, you can ladder in buys, which is what we did. So we had our buys right here, it got filled, and then price moved up. But if price continued downwards, or we got a bounce and then came back down, we would get filled at a lower price, and we placed that in just below the lowest point so far, because typically that's where most people are going to place their stop losses. That's where we place our buy order. So instead of getting stopped out on a trade, we're going to enter a trade where most people are getting out. And that's just because a lot of times you'll see this wick come up here and punch to a new high or punch to a new low, and then price will continue strong in that opposite direction. So that's like the spring shooting it in the other direction. So now assuming, like I said, so we'll have 33% of the position right here, we'll have 66% right here. So we're in a trade right now, moving to the upside. If this position never gets filled, that's fine. We move up here and we take profits along the way on our smaller position that we have open. If price did continue down and we got filled here and then moved up, we would have our full position. And then, worst case scenario, obviously, if price moved down and hit our stop loss down here, we would know that we're out and we'd be out of that position, and then we'd be looking for, a new entry off that, and we just basically were wrong on that trade. So here we have this range. Essentially what you're going to look to do is trade in the bottom of this range. We want to accumulate down here in the green, and then we want to distribute or sell up here in the red, and that's essentially like the bottom and top of the range. So what we know is basically until this range gets broken, until this channel gets broken, price is going to continue to trade within it, and then once it does get broken, we'll get the powerful move in that direction. But occasionally what will happen is you'll get a little fake out outside of that, just like this, and you don't want to get stopped out in your position, or you don't want to enter a position and then it immediately goes against you and you just got tricked. So what you're looking for is confirmed candle closes. So if you're trading on a 4-hour time frame, what you're looking for is confirmed 4-hour candle closes above or below those points. So that's how you're going to know for a breakout trade if we see it. But a lot of times with a breakout trade, you're going to miss the move, or you're taking a high risk chance of failure, because it's either going to be a fake out like this, or the second that it punches through, you're going to get this monster candle like that. And if you aren't just sitting at your computer waiting, and even if you were, you got the confirmed close right here, you enter the trade, and then bam, it dumps. I mean, that's a massive move right there. But if you weren't just sitting there waiting for that confirmed candle close, you would have missed this opportunity. You would have had a 4 hours, and that happened so quick. Um, so basically, I guess what I'm getting at is the best trades that you can take are just well positioned ahead of time, and then they turn into like the long-term winners because you let them ride. So in my opinion, if you were wanting to trade basically this breakout, if you're wanting to make sure that you're in a good position, in a good trade for this next big move that we have coming, whether you think it's to the upside or to the downside, if you're just not sure, all you can do is you can just accumulate through this or distribute through this zone right here, take shorts through the top of this range, take longs through the bottom of the range, and then you might have a long from this area, you might have a short from this area. They're both in the middle right here, both in profit. And then as one gets closer to the other, when the range finally breaks, you can take profit on your longs up here at the top of the range. You can take profit on your shorts down here at the bottom of the range, but you only ever taking profit on like a quarter of your position or half your position, and then you're just moving your stop loss accordingly. So you're allowing the market to, if it does continue in that direction, to let your trades stay in, but there's no way that you could ever be in a loser. So we took this buy right here. So now let's say, for instance, price continues to move up to the top of the range and we end up taking profits along here. Say we take out like a quarter of our position in here. Say we take out a quarter of our position in here or half of our position in here. So now we have a quarter to a half of the position riding. We'll have our stop loss moved up somewhere up in this range up here. So if price moves against us now from that, we don't just give back all of our gains and then it continues to trade inside this range. And then also, if you're at the top of the range right here, you could be shorting. And again, this is not financial advice, I'm just explaining how I do it. You're going to be shorting at the top of the range or taking profits on your long spot position accordingly. And then when price starts to move back down, you're in profit on those trades. And then should the price break out over here, you would get stopped out on your short. And then that remaining long position you have would continue to ride. And then you could take a continuation trade, as price continues to confirm and move up to the upside. And then vice versa. If we took, like, say for instance, let's go back here. You took this short sell right here, assuming you didn't get just stopped out on that big wick, or you took it anywhere in this zone. Now you're going to stay in position, stay in position, stay in position. Maybe halfway through the range, you'll take off a quarter of your position. And then as we get to the bottom of the range down here, what you're looking to do is essentially take more of your profits off the table, assuming the range is going to continue to trade back to the upside and you're going to stay inside here. Because it's only ever going to break one time. So if you stay in that trade, you're just going to end up basically bouncing around and giving back all those profits. Now, if you're just looking to accumulate over time or you're just looking to hold or whatever, then it doesn't matter. You don't have to trade the range, but you could just buy at the bottom of the range and short at the top of the range, and you can have a stop loss here and a stop loss here for either one of those positions, and then whichever one moves for you or whatever is the one that continues and the other one gets stopped out. So now if you took a buy right here and then let's say you took a buy in here and then price moves over here, okay? And then you took, I'm going to turn that one blue and then I'm going to make another one. And let's say you take a sell in here. So whichever way the price moves in, you're going to be already positioned in a good trade. So you're in a long from the bottom right here, and then if price breaks out to the top, you're going to end up in a great position. If you're in a short from here and price ends up breaking out to the bottom, you're going to be in a great position. And then if you're not looking to trade the range, all you do is you just put a stop loss in place for each of those trades. And then the way that it does finally break is the direction that you'll end up in the trade. And the way to do that is if you only have one account is, if you're buying spot, so if you're buying Bitcoin and then you can short Bitcoin on that same exchange, you can essentially have a spot position that's long and you can have a short position that's short. And as long as price is just moving around in this range, you're not gaining or losing anything, because if you have $100 short right here and $100 long right here, if price moves 1% to the upside, you made 1% here, or you lost 1% here and made 1% here. So you're just basically, you're hedged. And then finally when the price breaks, it's going to take out the hedge that was incorrect. So it would take out your short hedge right here, and then your spot would continue to be, growing price, and you're in a good position. And then vice versa, if it breaks to the downside here, you could sell your underlying spot, and then your short position would continue. So, but that's basically just a little bit on positioning, and how just taking a good position off of a range is what results in the best long-term trades, because basically you don't want to be a breakout trader. Being a breakout trader it has a very low success rate. Okay, so if you just take into account just that single trading strategy, and then you start to incorporate things like indicators and moving averages and things like that, Fibonacci zones, that's gonna basically help you to be a much more successful trader, because now you can look at this and we see, as we've had this broken down, that basically what are we really doing? We drew in these support lines and resistance lines here, but really we're just bouncing around in between the Fibonacci zones. We're right here between the 0.5 in green and the 618 in blue. So essentially, as long as we're in that area, we're just trading in this zone. So when we do break that area, we're looking at like the zoomed out picture now. When we do break through this area right here, the move we get is going to be a big move. The move is going to be somewhere between this length right here and this length right here. I mean, that's my anticipated moves. So when we break through this range, if you took a long at the bottom of the range and then we break up, I mean, that is if you took that position we have and this ends up breaking back up to test the resistance, that's a 23% move right there. If you took a short near the top of the channel and then we end up breaking down here to test this next fib support zone, that's a 15% trade. So either way, you're in a nice trade. So you could have a 5% stop loss on either one of those trades, and you're still looking at 3-to-1 to the downside, or like 5-to-1 to the upside. And that's what you're looking for. You're looking for high risk reward, and the best way to determine that is, pick a specific area that you're going to call your resistance or your support zone. And then from that zone, you can then take your positions, and then you can manage your risk. And that's the most important thing, is position size and managing risk. And you can flip a coin. You don't have to use any fancy indicators or whatever. Those alone will help you be a successful trader. So if you're taking positions through the bottom of the range and you're taking shorts through the top of the range, you're going to end up in successful trades more often than not, because we've already come down here to the bottom once, twice, 3, 4, 5 times. And we've come to the top of the range here, 1, 2, I mean, really, it's only like 2 to the top technically at this point in time. And really, 1, 2, 3, you call that 4. But realistically, if you were waiting for this range to break, though, it's been 6 times now, 4 on the bottom and 2 on the top, but it hasn't broken. Okay? And how many times has it broken? 0. So you can continue to trade this range and continue to be successful inside that range until the one time that you're not. The most important thing is position sizing and making sure you're not getting stopped out on a little wick like this, because this right here, that's a 4% wick. That's enough that if you took a bad position somewhere inside this range and then price moved against you, you would have got stopped out on it with a responsible stop loss. But if you took a position up here in the top, you might not have gotten stopped out on that. Or if you were expecting it to come to a new high and then price to move, you probably wouldn't have gotten stopped out on that. But if you just have one straight up entry price and you just bought somewhere in the middle of this range right here and you said, I think it's going to break out, you probably would have got or sold or whatever and said, I think it's going to sell back off. Or if you would have, bought somewhere near the top right here, sold somewhere near the top, you would have ended up basically getting stopped out basically off of this move right here, and then you would have lost. So it's important that you just get into and get out of these positions at a good area, and then you can let the positions ride in your favor, but just take some profits along the way, because you got to assume that it's going to continue just bouncing out inside the zone until it doesn't. So we're still expecting the same thing to happen. We're expecting it to move around inside the zone, and when it starts getting back up to here, it starts hitting all these resistances up where the 200 is, up where the top of the zone is and everything, right around that 8,500 mark. That's exactly when we're looking to basically sell or take profits, or enter shorts again. And at this point in time, I think it is likely. You'll see we've got the jewel thief poking up right here. We have this knife starting to come up to a pretty high level. Historically in the past, when you start seeing it up in this zone, that's calling the top of those moves. So we're getting close. I mean, this was like We're basically at that resistance point right now, and we're also at that resistance, the diagonal green that we had drawn in, and we're also at that 50. So is it unrealistic to think that we put in a lower high right here and we get stopped by these two resistances? No, not at all. I think it's completely possible that we continue back down now here and sell off.